Good morning, good afternoon, good evening, no matter where you are in the world. This is Howie, and I'm here to help you win with money. Today is Tuesday, March 22 of 2022. It is the second day of week number 12. So what I want to show you today is what I am doing with my RIOT blockchain. So it's over here, and we're going to get into it. I'm going to show you how I am playing this using a cover strangle. Before we go on, if you're on Facebook, join me on this Facebook group, Investing 102. This is where you can level up your investment knowledge. You took the 101 course already. That's stuff that you learned. Time to move up your knowledge to level 102. The beauty of this is generally when I post trades, I try to put it out there as soon as I can, literally within 5 or 10 minutes of the trade, so you can see it. You don't have to wait for a YouTube video. So let's get straight into what I do with RIOT blockchain. So let me just show you something interesting with RIOT. Let me show you the chart. RIOT is kind of hard to play. If you see this chart, if you're on the wrong side of this movement, you're going to get hurt. If you're using a cover call, right, you're going to limit a lot of your upside. And we saw that on this way up. So when RIOT was down here, if you had a cover call, it shot all the way up to $60, it says. And if you bought it near the peak and use a cover call, you're still hurting because it went as low as $12. So I'm going to show you something real quick. I'm going to jump into my E-Trade account, and you can see this is RIOT. I do have a couple of shares, 300 shares, and I have an average price that is above market price. But what I want to talk about is my holdings. But before I get into what I hold, I'm going to show you what the perfect and ideal scenario is for a cover strangle. In order to explain this, let's assume you just bought the shares today. We can see that right now it's trading at 20.53. So I'm just going to update this real quick, 20.53. Let's say you want to put a cover call on this thing today. So you wouldn't want to go that far out. If you bought it at $20, you may want to do a $25 cover call. You see this? It's fetching it will cost you well, if you're going to sell a cover call, we'll give you the worst price, which is $157. So you will collect the $157. And the second piece of this is you need a put. So I'm just going to change this real quick. And let's use the same date, but let's use a price that if you bought it for 20, you're not going to do it for 19. You're probably going to do something like this. If we're doing a premium, let's say you're getting the lower of the two. So let me explain what this means. You bought the shares at $20 or $20.50. You're going to write a cover call saying, if the share goes above 25, you're not going to make any more profit. So you're only going to make profit between the current price and up to 25. But in exchange, you receive $150 for it. And this contract is good for about 7 weeks, or maybe even longer than that. So maybe 8 weeks or something like that. On the other side of the trade, what you're saying is, if it goes down, I'm going to put a cash curve put saying I'll buy more at $15. In exchange for that type of bet, you're going to receive $92 today. Your broker will lock up $1,500 of your cash because you're agreeing to buy it at a future time at $15. So what does this do for you? Well, the first thing you're going to notice is this share price can either go up, down, or stay somewhere between these two. If it goes up, you're going to make money because you made an extra $4.50 on each share that you own, plus you receive this $100. Now, if the shares drop, you keep this $150. Now, this share price now is worth $15, but you can say, do you want to buy the shares at $15? Now, normally what I do is, when I'm doing this particular strategy, I'm not looking to buy more shares unless you really want to. I'm generally going to roll this down again and collect another premium because I'm using these opposite ends because you can only lose on one side. Even if it goes up to $24, what I'm going to do is roll it out. So you have to envision what this will look like in the future. So in the future, let's say the stock goes up. What you do is you let some time go, and then you may want to move this up to $27, and then you collect. I'm just going to make something up. Let's assume the premium a little bit smaller in the future, and if it's up to 27, right, you want to roll this one up, and maybe that's too close, but you'll collect another small premium here. With the goal of you're trying to collect premiums on both sides, on the put and the call side, so you can make money regardless of what happens. Does that make sense? And this is why you can now improve your earning potential using a cover strangle. So now you understand what is the perfect scenario. This is like the perfect scenario. Your put needs to be under the market price. Your call needs to be above the market price. And you can see when I change it, you know how much premium you're collecting. I mean, this is a lot of premium. When you look at this, you're collecting $250. And you're only putting up $2,000 of capital to buy the 100 shares. And that's in about, again, 7 or 8 weeks' time. Now what I want to talk about is when things don't go your way. And that is exactly what happened to my holdings. So you can see my holdings are listed over here. So we'll just use, to make it easier, since we're talking about a cover strangle, we're going to pick a cover call that I have. And I have one over here. I have a cover call for $23. So let's do this. $23. We're going to reduce this. We're going to hide all this now. We'll use the same $20.53, and then I have a cash occur put. And you see this? I have a put here and a put here. We'll use the May one just so that the Mays are easier. We'll pair these two up. So I have a put at $33. I have a cover call for $23. And you notice this? It was sort of the perfect scenario. This is not the perfect scenario. And I'll explain what happened. I've been rolling and rolling and rolling, and then the price moved, and I've been caught on the wrong side of the trade. Now, you tell me, okay, well, isn't that bad? Well, it is bad, but let me show you some of the math of why some people love trading options. So the first thing I'm going to go show you is this call here, this cover call. So we're going to go to this May 20. If you hit the close button, you see that? It'll cost me $2.22 to close it, so that's bad. But if I roll it, what do I need to do to get a credit? Well, you see, if you roll it out into the future, you're going to get a credit. But I don't want to just roll it to $23. This is a cover call that I want to roll all the way up to, let's say, $30. And you see this? This is really bad. It's going to cost me money. So let's change the date. So in September, you see this? It's saying I will get 46 cents credit. So I can move this to a $30. And in exchange, I will get $46. Now, if I did that, how do I fix this put here? If you close the put, you see this, it will cost you $1,390. Now, if you roll it, let's pick the same September, and what can we do? So here's your option here. You can roll it to the same $30, which is moving your $3 down. Now here's the problem. I'm going to use the worst case scenario. It's going to cost me this debit here. If you look at the net, I'm losing $60 to do this move. So would I do something like that? Maybe not. Now, why would you do something like this? Well, because you are moving the strike price, the cover call, up in case the RIOT shares continue to go up. You are moving the cash to put down because the goal is eventually try to get out of this bad position. So let's play around with some of these bad things. Suppose I just stretch this out into a further date and time. And if I use something like this, let's see what we can do. So the put side doesn't really look too good, even if I stretch it down a few dollars. Maybe this is really the best answer. You move it to a $30. Now we're actually going to get a 55 cents credit. And if we go back to the cover call, We'll use the same calendar date, move that up to 30 bucks. And you see this credit is so large, which is wonderful. Because the credit is so large, you can actually do something like this. Move it up to $35 and you still receive $105. Now look what it's saying now. Now you're collecting $160 up front. My put is now under my cover call, which is sort of what you want. You want to try to get back to this perfect strategy here. Now it's not perfect because you need RIOT then to trade between the put and the call. Ideally, what most people do is they wouldn't do this. You will do it in steps. What they would do is something like this. You would actually do the $30 here. So what most people will do is something like this. They'll do the $30, collect your $197, where the midpoint, you see now we're sharing the same point. With the go of in the future when you're rolling, you're going to roll this down and roll this up. Because, again, the end go is you want the share price, this share price, right, to be between these two prices, the option price. So my optimum solution, right, my end go, and I'm just sort of showing this, right, my end goal is eventually get this higher up, right, to like 35 bucks, and then the end goal for here is to get it down, going from 33 to 30 to maybe 25, and then eventually I would like the shares of the underlying to be trading between my short put leg and the short call leg. But you see, I showed you the premiums that I am not dead in this trade. I'm not losing money in this trade, even though my put is above the market price and my cover call is under the market price. Well, actually, it's not under. I'm sorry, I said that wrong. But you see, we're pretty close. So I have a way to fix this, and over time, I'm going to try to get it to look like this scenario. For those of you who watch my previous videos, I basically roll RIOT all of this year, and I did it most of last year. Last year alone, I collected almost, I think it was over $5,000 in premium just in rolling RIOT cash secure puts, and then I added cover calls towards the end of the year. So now I'm in this weird scenario because the price went so far down. I'm stuck in a, really, it doesn't look pretty. It's not really a cover strangle anymore because the prices are not in the right place. But I'm going to fix it. And if you watch my videos over time, you'll see how I get out of this. Hey guys, I know this is maybe something that a lot of people don't talk about. But again, if you look at some of my old videos and look what I'm doing with the RIOT, I never really talk about why I'm rolling. But this is the one where I'm trying to get it back to this position here, where my put is lower than the market price and my cover call is above the market price. And today is not. So stay tuned. Hey, follow along. It may take me a year to get out. It may not. It all depends on what happens with RIOT blockchain. If the shares sort of level out and don't move anymore, it may take me 2 or 3 years. And I'm okay with that. As long as I collect some premium, doesn't take me money out of my pocket, but I can sort of collect some money every time I do it, I'm okay with that. The goal is to make money on every trade and make my position a little bit better. Hey, thanks again for watching. Comment below, give me a thumbs up, share this video with somebody who you think will benefit from this. Let's help the YouTube algorithm help other people find my content. Hey guys, that's the end. Don't forget, let's do this together. Let's do this $1 at a time. As always, have a profitable day. Bye-bye.